Good morning, everybody. Welcome to today's live broadcast from Interactive Brokers. My name is Andrew Wilkinson, where I am the Director of Trading Education. Joining me is Josem Torres, Senior Economist down somewhere in Florida, hiding. How are you, Jose?
I'm doing great, Andrew. Unfortunately, we don't have data, but we already scheduled this event, and how could we disappoint the crowd and
What do
not
you
show up?
What do you mean we don't have data this morning?
Well, the government shut down on October 1st. Republicans and Democrats remain in a heavy grapple over healthcare legislation. The Republicans don't want to budge on Democrats' requests for concessions, specifically Medicaid cuts. Democrats want to pare that back. That was integrated in the big, beautiful bill, as well as the Obamacare era health insurance subsidies that are set to expire by the end of this year. So really, those are the big two sticking points in Washington. The Republicans are responding. President Trump and the office is responding by trying to permanently lay off hundreds of thousands of federal workers from certain agencies. Historically, when you have a government shutdown, what tended to happen is that folks would not work for as long as the shutdown lasted, and then they'd come back and then they'd get paid for the time that they weren't working. So that would really contain the disruption on the economy in terms of consumption. These folks, they need to pay their rent, they need to buy staples, they need to, they have expenses. So that would contain the economic shock. However, this time, and this is, of course, is going to be probably a lengthy, heavy battle in court, but this time the administration is looking to permanently terminate some of the federal workers, and really brings back memories of the earlier days of the administration when Tesla CEO Elon Musk was involved in the Department of Government Efficiency that was trying to downsize the federal government and reduce spending. This is sort of a second attempt at that effort after, those more extreme efforts in the beginning were sort of abandoned after 2 months or so.
So we have nothing to talk about.
Well, we do. We have the government shutdown contract for November 1st in our forecast trader. For those that don't know, we're now involved in the prediction markets. Simple yes and no answers to questions spanning from politics to elections to economic indicators, of course, when they are released, as well as climate contracts as well. But for those that don't know, we're going to play a commercial from our chief strategist, Steve Sosnick, who talks a little bit about the forecast trader. And then we'll move on to the November shutdown odds, because folks in our marketplace are pricing in the probability that this could be a very long standoff. 34% think that this could go beyond November 1st.
Hi, I'm Steve Sosnick, chief strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on Forecast Trader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
Jose, before we get to the odds of a government shutdown in November and December and so on, we should really talk about the market impact of what's actually happened. I think it's fair to say that people gave a pretty strong likelihood to this eventuality panning out. So how has the market taken it?
The market has taken it really well, believe it or not. The stock market has continued to rally, driven by rate cut optimism, as well as evidence that the AI revolution remains in its early innings. We got some, your cat is in the broadcast this morning as well. Well, that's wonderful, as well as your delicious coffee. Is that British coffee?
It's Colombian coffee.
Okay, closer to my neck of the woods.
Well, join the dots for us there, Jose. Why is the stock market higher? What join the dots with the optimism on rate cuts and stronger stock prices?
Yeah, so the government's closed, but the private sector remains open, folks. And ADP came out with a report Wednesday signaling the weakest, the strongest, the heaviest number of job losses. So the deepest number of job losses, the most job losses in 30 months, 2.5 years, going back to March of 2023.
So 32,000 jobs lost, according to ADP. Now, they don't. We've talked about this many times before. They don't often tally, but it would seem to be in line with the trend in the labor market, right?
Yes, the trend has been decelerating. In fact, when you look at the ADP report, 3 of the last 4 months, so September, August, and June, those 3 months featured losses. Out of the last 4, only July has featured an increase. So that's a very worrisome trend in terms of the momentum in the labor market. And there's a lot of factors driving that weakness. Part of it is that the Fed is too tight here, folks. The Fed is late to the cutting cycle, in my opinion, unfortunately, and that's weighing on hiring appetites in some of the more rate sensitive areas like small business, real estate, as well as manufacturing. And without some accommodation, I'm afraid that I'm not confident that those areas of the economy can become more buoyant in terms of headcount additions without those rate cuts. But Wall Street is pretty confident that the Fed's going to reduce rates in October and December. I'm going to share my screen here and pull up some of the odds from our forecast trader.
I think immediately after the shutdown, so what was that, Wednesday morning, the market moved to 100% likelihood, did it not, that the Fed will cut rates by at least 25 basis points at the October meeting. It's a done deal, right?
Yeah, pretty much. 89% chance here on our forecast trader of a move down 25. A move 50 or more has a much lighter likelihood of just 3%. When you look at the December meeting, also 73% chance of a 25 basis point reduction, 6% chance of a 50 or more. So roughly 80% chance of a move in December. January, more here's where participants aren't really sure. The no change is trading at 50-50 for January. So some folks think that inflationary pressures, which recently have really been driven by services and the buoyant consumer demand, that may stop the Fed after cutting for 3 consecutive meetings in September, October, and December. January is a 50-50. Wire market. Sorry.
When you look back, Jose, last September, when the Fed began to cut, they cut 50, followed by 225. So they cut rates by 1%, didn't they?
Yes, they cut rates by 1% last year, and this year is looking like they're going to cut by 75 basis points.
Yeah, it seems a little kind of strange to me that markets are so convinced that they'll only do 75 rather than going for a full 1% off. So that January contract, and I get the circumstances are different, particularly with the uncertainty over the impact of tariffs, but that to me would be the standout.
Right. And one thing that's also been helping the treasury market, particularly at the long end, and that's another reason why stocks have done well against this backdrop in the last few days, marking fresh all-time highs several times, including yesterday, October 2nd, is that the government downsizing efforts do bode well for term premiums dwindling. So the concern that investors have over fiscal budget dynamics is reflected in term premiums, and that drives long end interest rates much higher when folks are worried. But when folks are more satisfied with debt and deficit issuance dynamics, then that comes down and that helps to drop long-term interest rates. We've seen it all year, 3 consecutive quarters of rallying treasuries, lower interest rates. Part of that has also been from the tariff policy. That's also helped to bridge the gap partially. Of course, the gap is particularly wide between the Treasury's expenses and its revenues by boosting revenues. So now this effort here of government downsizing is boding well for prospects of lighter expenses, and as a result, a better fiscal situation here in the US. And valuations and equities we know have been extended for quite some time. If you ask classic value investors, they've been overvalued for 25 years. So those lower interest rates at the long end, if it manifests, hopefully, then that'll alleviate some of those valuation worries that we're seeing in stocks. We very well might have another 20% plus more year this year after having that kind of a run last year as well as the year before in 2023.
Jose, does the rally in the stock market concern you?
No, it doesn't concern me. In fact, I think the way I've been thinking about it and the way a lot of investors have been thinking about it is they're more afraid of upside risk than downside risk.
Missing
They're
out.
more missing out. They're more concerned about missing another 20, 25% year than the market going down 25 or 30%, which of course is possible, especially after a significant run and the valuation excesses. And we are particularly vulnerable to AI underperforming if it does. But right now, that's not the theme. AI is performing well. It's heavy adoption, heavy capital expenditures, and Wall Street is betting that that's going to be able to drive profits over the long run. And that's why they're fine increasing the valuation multiple on the S&P 500. Overall, I'm not worried because the profitability of the firms driving the gains have been particularly stable, and they remain on solid footing in terms of the trends that are driving them.
I'm wondering what the odds are, or what the market is kind of giving equal odds at this point to year-end stock prices.
Oh yeah, we're going to check that out here in our forecast trader. We'll go with the S&P.
So we're currently around what, 6,700?
On the futures, we're at 67.75. So 6,800 would essentially be the mark where, we're slightly out of the money in options terminology to the upside. So there's 62% chance, according to our participants, that we're above 6,800 by year end.
What's the next benchmark there? 7,000?
7,000 carries 40%, 7,200 19%, and 7,400 6%. So if you're really, really bullish and you think that the S&P is going to finish above 7,400 by year end, the futures, then you could buy this contract for 6 cents and get paid back $1 at year end, which will be a particularly, a return of almost 20 times. And that's sort of how these prediction markets work. The cents on the yes and on the no correspond with the probability of that particular event occurring. Now,
is the March contract as of the 31st of December, right?
Yes.
Yeah. So I'm hearing an increasing amount of commentary comparing what's happening now in the stock market to what happened in the dot-com bubble that burst around 2000, 2001. What are your thoughts on that, Jose?
Yeah, it's really going to come down to the artificial intelligence and its ability to drive profits. We know that in the dot-com crisis, a lot of the firms, they weren't able to meet expectations, which were particularly lofty. And that's what it comes down to this time. So far, it's, we've been going on since 2023. The firm is the Magnificent Seven. They feel very committed to boosting AI expenditures, and they believe that it's going to pay off. So right now, we're everything is rosy. But if for whatever reason, at some point, AI doesn't meet expectations, then at that point we're vulnerable for some repricing to the downside.
I think the big difference,
However,
Jose, is a lot of these companies today are profitable, whereas back in the late 1990s, there was no earnings in the PE equation, was there?
right, yeah, there were no earnings, and you had a lot of small companies that were involved in a lot of the internet stuff that didn't work out.
Yeah.
But now you have, like you said, you have heavy earnings, and this is also becoming more of a defense kind of theme, right? Because AI is so pivotal to national security at this point. So it's has much more government involvement. And so the Trump put, if you want to call it for now, government officials are committed to supporting their domestic AI industries. So that's another key differentiator from the dot-com bubble to now, is that we're essentially in an AI race with a lot of our adversaries, particularly from the Far East, Moscow, Beijing, etc.
All right, let's move on to the chart that you have on the screen. Just can you define that contract for us? Will the US government enter a partial or full shutdown on November 1st, 2025? I like that because we're in it, right? So that's the odds of this today are 100% because we've closed down, right? So this question essentially means, will they've resolved this problem by will the government have reopened by the 1st of November?
Yeah, and 64% of participants think that participants assign rather 64% odds that it will reopen because of the no, but the yes is at 34%, meaning that there's risk of a prolonged shutdown. Of course, that would be problematic for the Washington, D.C. area, which employs a lot of federal workers. Most in the country work there, and then have a highest share. And then also, when you consider the lost spending and the potential lost income over the long run, if the White House is successful in downsizing the federal workforce, investors that are worried about a potential economic slowdown, or that think that the likelihood of this extending past November is particularly high, that 34 cents would become $1. But if you think that the situation will resolve itself, then 64 cents, that would be your investment here.
I've got two questions for you. First of all, is that the only contract expiration at this point, or is there a second one? I'm thinking of a spread trade here, but buying a yes and then buying a no for the next contract. So when would the next contract come out if there isn't another one now?
So right now, there's no other contract for the future months in our space, but there's potential of it coming out in the next few days.
Yeah.
And we'll also be adding a disclaimer to this contract soon because, like you said, we're already in a shutdown. So the question, of course, will apply to us not entering another one, but just remaining in it would be enough for the yeses here to win at settlement.
Yeah, I would be inclined to add a mid-month date or a weekly date, like move on from the 1st to the 8th and then to the 15th rather than looking for December the 1st. But that's just my thought. My second question, Jose, would be, does a government shutdown suit the president?
Usually I don't think so. I know there's mixed opinions here. I don't think so. I think that it plays into the hands of the Democratic Party at this point because the Medicaid cuts, they're domestically unpopular amongst the lower and middle class folks, as well as the healthcare insurance subsidies. Those are things that are popular amongst the domestic constituency. So because those are the sticking points, and usually the party in power is blamed for a shutdown, I think that it doesn't help the current administration. I think it helps the opposing party.
So what does what does the government shutdown mean for the labour market at this point? You said very little in terms of, I mean, the domestic economy continues. It will keep going. Government workers will be potentially furloughed or even fired permanently. Should we be worried about the economy?
I think in the short run, we should be worried that the pace of advancement is going to be curtailed down. We're not going to be able to grow at the fastest potential, for example, in the fourth quarter, because of this shutdown, especially if it extends further. And I'm afraid that this shutdown came at the wrong time, because the economy, the labor market overall, has been accelerating. Consumer spending has been terrific. We have retail sales 3 months in a row of robust gains. Capital markets have been thriving. So, the shutdown adds a vulnerability at this point, while the economy was rebounding from the turbulent and volatile first half of the year. And now I'm afraid that this can spark some bumpiness in the second half of the year and limit our growth potential. But again, the silver lining is that if the downsizing efforts do work out and government expenses are reduced meaningfully, then that can reduce long end interest rates and provide a stimulator to the economy next year, even though this year the level of progression won't reach its full potential.
Well, we've gone past 8:30. There is no BLS, the Bureau of Labor Statistics report today. First of all, when will the report be published, if at all? And what happens if you have a wager if you have an open contract on the IB's forecast trader? What happens to that contract?
Yeah, that contract essentially waits until we'll pull up the contract now. That contract essentially waits until the report is published, and then that's when it'll settle. Unfortunately, the settlement date is unknown at this juncture, but that's the policy right now. So, you can't, this market is closed here for September, right? So whoever invested, we have open contracts down from the negative 350,000 all the way up to the 600,000. So whoever took positions here will just have to wait until settlement, which of course is unknown.
But the report will be packaged up and released at some point, won't it? Even if it accompanies the October jobs report. Yes,
it might accompany. It'll be reflected also in the revisions too. As the BLS catches up. As the future months, once the government reopens, the future months will inform the past months. That is, of course, presumably the expectation of, because the bureau has been understaffed for a while, and if the government is closed for 45 or 60 days, who knows how long it'll take the bureau's workers to catch up and to rectify that data, analyze that data, and make sure that it's out with a high degree of quality.
So now you showed us the government shutdown event contract. All government-related data points are on hold, as long as the shutdown lasts. What other contracts are out there for individuals to look at?
Yeah, so we have the consumer sentiment contracts from University of Michigan. That's going to come out. Consumer confidence from Conference Board. That's also an instrument. The Fed's weekly economic index. The Fed isn't closed. The financial regulatory agencies like the FDIC, the OCC, as well as the Fed, those remain open. So the Fed decision, of course, that'll remain an instrument, as well as the industrial production release. That's from the Fed. Other than that, of course, we have a lot of international contracts, international instruments like the Singapore CPI, the European Union unemployment rate, the GDP for Canada, et cetera, et cetera. So we have a wide list of international contracts that folks can come in and engage with as well. So, just because the government's closed doesn't mean that you can't engage with our prediction market.
Any questions for Jose, please do put them onto the, address them through X and LinkedIn. There's a few questions coming in there. We've just addressed the one from Sultan Boy. NFP was removed from Forex Factory. Does that mean they're not going to release it? Well, it will ultimately be released. What do you make of the news this week, Jose, that I'm not sure which court it was, but Lisa Cook gets to keep her job at the Fed pending arguments to be presented in January, I believe.
Yeah, I don't have, heavy opinions on that. Next question, please.
That's okay. And of course, we didn't get any initial claims the data yesterday either. So a little dry in terms of following news on the jobs market. So we have to rely on private sector data points going forward until this resolves, right?
Yeah, we had ADP, we had Challenger Gray reflected softer hiring plans alongside lighter firing intentions last month, marking the weakest September for potential roster expansion since 2011, and the lowest year-to-date numbers for new employees since 2009. So Challenger pointed to a soft September. And then Revelio Labs, they also produce a monthly jobs report similar to ADP, lower profile report. But that's what we do, right? When we have a lack of data and the buffet is empty, then maybe we go out to the farm and find some new ingredients to supply the restaurant with. So Revelio Labs signal a 38,000 payroll gain in tomorrow's suspended non-farm payrolls report today, that is. Yeah. I'm reading from yesterday's article that I wrote with those folks that want to subscribe to our Traders Insight email, as well as the Economist Insight email. Feel free to reach out to us. We're happy to add you to that list. Revelio Labs signaled 38,000 payroll gain for today's BLS report. Education, healthcare, and retail sectors gained, while leisure, hospitality, and business services declined. So Revelio Labs produced a number that was below today's expectation. Of course, we're not going to get non-farm payrolls today, but the expectation was that there would be a 50,000 employee gain.
Which conflicts with the ADP report as well. There is a question coming from MG. I thought I recognized the flag. He said, is it available for Saudis that use IBKR to invest in IPOs? And I think the answer to that, MG, is no. I know that we make IPOs available to, I think it's clients of IB Hong Kong, but not in general, I'm afraid. What else? What else is kind of front of mind for you these days, Jose, as you look at the economy developing?
Yeah, so the fourth quarter tends to be the strongest for equity market gains. So hoping that we have a rally to finish off the year. Of course, government shutdown worries. I'm watching that in terms of how it's going to impact consumer spending, economic growth, but also how it could possibly improve fiscal conditions, and really analyzing the data that we have coming in, focusing more on international markets because they still have data.
As you say, at the company level, the private businesses continue, the economy is open, and it's at times like these when I think we start looking a little bit more closely at. So, for example, to understand how the consumer's feeling, we start to look at like restaurants and the foot traffic there, the footfall that had been coming off a little bit, is my understanding. I think people closing their wallets, purse books a little bit more.
There's a lot of anecdotal evidence, mixed reviews. I think overall the discretionary categories were improving, and the data does, tends to be very noisy. But from my perspective, the discretionary categories, namely restaurants, hotel stays, airfares, those have been really buoyant. We've been hearing from the airlines. Restaurants have been mixed. Hotels have been really strong as well. But my understanding is that the discretionary category is really rebounding strong in the second half of this year. Of course, the shutdown threatens the reacceleration theme. So yeah, hopefully AI keeps producing good news, because that's been a stimulator for equity markets, and it's helping growth prospects as well as valuation expansion. And hopefully interest rates can keep falling. It'd be great for the 10-year to go down, to sink below the 4% level. Right now it's at 4.09, and the 2-year to sink below the 350 level. I think what we're looking at here, folks, if the government downsizing efforts do pan out and but the economy keeps growing strongly, is that we're looking for a flatter yield curve. The 10s can maybe fall to around 350, 375, and the twos can be at roughly 325. So after having a much steeper curve driven by strong growth expectations, expansive term premiums, and heavy growth projections, I think now the term premium conversation, as well as inflation expectations and growth because of the shutdown, I think that can bring down long-term interest rates due to those factors. While the shorter term tenors, they can remain closer to where they are, because I don't think the Fed can cut much more after December.
There's also, again, looking at private surveys, what about job postings? I think Indeed.com is one of the companies that posts that. And that data set has been coming off the boil since it peaked in 2023.
Yeah, job postings were recovering strongly in the second half, but then in September they really started to take a dive. And now, yeah, we're actually at the lowest we've been since. I'm just gonna share my screen here so you can all see with me. So we're here now. We're at a year-to-date low of 102.93. We got to go back to around February of 2021. So almost a 5-year low in job postings. These are for hire signs, essentially job openings, which measure labor demand, right? Are employers out there looking for more workers? So this is down to almost a 5-year low on Indeed. After, should have showed you the shorter term chart, but I'll show it to you now. After, in the second half of the year, we started to get a recovery here from July 14th. We made it up north through October 22nd, but then we started to lose momentum in the later days of August, and then in September we've just begun to plunge. So yeah, labor worries are there. Of course, part of what's hampering the performance in the labor market is a lack of immigrants. The migration policies really reduced the pool of prospective workers. You don't have enough people wanting to work. And then also AI, artificial intelligence, is doing a lot of entry-level tasks. And that's really helping corporations avoid adding workers. So those are two themes right now they're watching very closely as far as the labor market is concerned, because labor market is decelerating, but consumer spending is accelerating. So, it's really a odd bifurcation that we don't see every day.
I suppose we could look at the like companies like Visa or MasterCard, certainly to look at the number of transactions, the daily or weekly volume of transactions, to understand how consumers are doing as well.
Absolutely. We know that there's been evidence that the wealthier households have been contributing more to consumer spending as a share relative to the lower and middle income households that have been, they tend to participate less in asset appreciation. So their pocketbooks aren't as flush with cash. They've been also dealing with inflationary pressures as well as heavier interest rates. So overall, we're seeing that that whole dynamic could start to slip further if labor conditions don't begin to rebound, towards the end of the year and into next year. And we also, because of those AI and immigration developments, we're also, we're expecting that we're not going to have six-figure job growth in many months like we've had in recent years, where sometimes job growth would be 200,000 or 150,000 or 300,000. Positive numbers are going to be 30,000, 50,000, 60,000, 25,000. We're much closer to the negative now.
What are some of the forecast contracts telling us about year end, Jose? I mean, we talked about the stock market. What's the forecast for something like the 10-year yield? Well, we talked about the interest rates too, but what are the, how are investors looking at this through the lens of forecast contracts?
Yeah. Just navigating here into the stock market indices. The S&P has been particularly bullish. Let's check out the Russell.
And the Russell looks at small caps. There's a potential arbitrage you could play. You could do lower interest rates are typically good for smaller companies that might be more capital. A lot of those small companies actually lose money every year, right?
Yeah, they lose money every year, a lot of them, and they're also much more levered to the domestic economy as well as monetary policy accommodation, because they tend to have heavier valuation multiples, and their balance sheets are more troublesome in terms of having heavy numbers of debt. So lower interest rates do certainly help them disproportionately. So if you think a big rally is coming to push the futures above 2750, 14 cents here on the yes would become $1 if the March futures settle above 2750 at year end.
Yep. Gotcha.
I think we're good to wrap up at this point, Andrew.
Okay, Jose, thank you very much for a detailed discussion today. That's particularly good in light of the fact that we got no government operating, and we got no.
Yeah, we'll be back on CPI Day with Andrew Wilkinson. Despite there being a report or not, we still enjoy engaging with you all and staying on schedule. Also, we have our first Spanish communication live stream, same exact setup as this, except that Judith Casasampere, she's our Latin American sales lead. She's going to be hosting me once a month. That'll be on Retail Sales Day towards the middle of the month, CPI and retail sales. So we look forward to seeing you all then. Reach out to us if you want to get more involved with our content on Interactive Brokers Campus, as well as all of the other tools. And if you need any information, of course, you can also reach out to us. There's also a Reddit Ask Me Anything event starting at 9 a.m. So if you didn't get a question in during this session, but you want to later, then feel free to catch us on Reddit in 5 minutes.
Thanks, Jose, and thanks to the audience. Bye for now.
Bye, everyone.